Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing AT&T stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AT&T is a holding company headquartered in Dallas, Texas. Through its subsidiary, AT&T Communications, it is the world's largest telecommunications company, the largest provider of mobile telephone services, and the largest provider of fixed telephone services in the US. It is the parent company of Warner Media, making it the world's largest media and entertainment company in the world. AT&T began as Southwestern Bell Telephone Company, founded by Alexander Graham Bell in 1877. The Bell Telephone Company became the American Telephone and Telegraph Company in 1885 and was rebranded as AT&T. Let's get started with the model. This is a large cap company, $205 billion market cap. They're trading at $29 a share, and they have 7.1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive and pretty healthy free cash flow each year. Net income is the profit and loss on the income statement, and it looks like their net income is decreasing each year. Revenue is a sales for the company, and that grows from $160 billion to $181 billion, then slips in the trailing 12 months to $173 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is cost of revenue. And then when you take revenue minus cost of revenue, it gives you your gross profit. They did have lower gross profit in the trailing 12 months when compared to 2019 because their revenue was $9 billion lower. Below gross profit is operating expense, and gross profit minus operating expense is your operating income, and that was $26 billion, a little higher than 2018, but a lot lower than 2019. This company has a good amount of debt, so they have a little over $8 billion of interest they have to pay in their debt, and then other income and expenses which are not tied to their everyday operations. Then, of course, taxes, and their net income was $10 billion, which seems to be decreasing each year. The company had its highest net income in 2017 with its lowest revenue, and it was because of this $14.7 billion tax rebate. So their pre-tax income was $15 billion, then they add $14 billion of taxes, so they reported $29 billion of net income. This is the statement of cash flows, and the top line is operating cash flow. That's how much cash the company generates from its operational business. And then you have capital expenditures, which are investments in property, plant, and equipment. And operating cash flow minus CapEx gives you your free cash flow. So even though they had a lot of net income in 2017, they only reported $18 billion of free cash flow because that tax credit was a non-cash item. So they're doing really well in free cash flow, $28 billion. The company issues a lot of debt. They issued $49 billion in 2017 and paid down $12 billion. That's an increase of $36 billion of debt. In 2018, they decreased their debt $9 billion. In 2019, they decreased their debt $13 billion, and they decreased it $7 billion in the trailing 12 months. It appears the company also issues capital stock, but they pay back more stock than they're issuing. The most important part of any business is their operating cash flow, because if you don't have positive and healthy operating cash flow, you don't have much of a business, because you can't rely on debt and equity to run your business in the long term. To calculate operating cash flow, you take your net income, which is $12 billion, and then you have to add or subtract the non-cash items on the income statement. They pass through a $28 billion depreciation expense, so we have to add that back. They also pass through $3 billion deferred taxes, so we have to add that back, and a $4 billion impairment. You also have to adjust for changes in working capital. They had negative $14 billion in working capital. That's changes in accounts payable, accounts receivable, inventory, things like that. Even though they had $12 billion of net income, they actually generated $45 billion of operating cash flow. So this company has tons of cash to work with. Let's look at a capital structure. $201 billion of equity, $185 billion of debt. And their net debt is $172 billion. That's debt minus cash. And they're 52% equity, 48% debt. and their WACC is 5.5%, which is a blend of the cost of equity and cost of debt, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $908 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $818 billion. We divide that by 7.1 billion shares. We get a calculated stock price of $115. They're trading at $29, so they're trading at a 75% discount. It's a really strong buy according to the model. Simply Wall Street is also saying the stock is undervalued, just not as much as me. Their valuation is $71. So you can see the stock was up and down the past few years, but then dropped a lot in March, and it hasn't come up at all. It's trading at a really big discount relative to its all-time high and relative to my valuation and Simply Wall Street. A stock price is not based on what a stock is worth. It's based on what investors feel it's worth. If investors feel a stock is worth $100, they'll pay $100. If they feel a stock is worth $10, they'll pay $10. It's all based off of supply and demand of the market. The market just doesn't see the value in this company like I do. The company raises their dividend each year just a little bit. They're up to 52 cents a share, and they pay a really nice dividend, 7.25%. To calculate dividend, it's annual dividend payment over market cap, or you can take the last 4 dividend payments, sum them up, and divide by the stock price. So as the stock price comes down, the dividend yield goes up. The company's payout ratio is 135%, so they're paying more than 100% of their net income. But when you look at the annual dividend payment over free cash flow, they're actually paying about half of their cash flow. Because the income statement is your accounting profit and loss. There's a lot of accounting things going on, non-cash items in there. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have about $17,000 today. If you did not reinvest the dividends, you'd have about $16,000 today. So this stock has gone up a little bit. It's kind of like a turtle. It doesn't move too much. The stock, as you can expect, has a low beta, 0.67, so the stock moves less than the market. And in the past 52 weeks, it went down 26% relative to the S&P 500, which went up 16%. And the 52-week low was 36, and the high was 39.55. And the stock is trading below its 50-day moving average and 200-day moving average, so it's on a downtrend. This is a really liquid stock. Nearly 40 million shares are traded each day, and almost all the shares outstanding are on float, which means they're available to be purchased by investors. And a little more than half the shares are held by institutions, and the company has a pretty low short percentage. Under 2% of the shares are shorted. Vanguard is a top shareholder, holding almost 8% of the stock. BlackRock almost 7%, then State Street, Newport, and Geode. Let's look at their financial ratios. The average PE in the market's 12, the median is 14.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 18.7, so they're a little worse than the median and average. This means investors are paying $18.70 for $1 of earnings. Price to sales is stock price over sales per share. They're at 1.2, so they have a really good price to sales ratio. Price to book is stock price over book value per share. They also have a really good price to book ratio. To calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $201 billion of equity, but negative $119 billion of tangible equity. So they have a lot of intangible assets on their balance sheet as a result of their many acquisitions. Interest coverage ratio is EBIT over interest expense, so they can cover their interest payments more than 3 times. ROE is net income over equity. They're pretty low at 5%, lower than the median and average. Current ratio is current assets over current liabilities. They can cover 80% of their current liabilities with their current assets, and their current assets are $12 billion of cash and $22 billion of receivables. So the company isn't too well capitalized. Even though they generated $28 billion of free cash flow, their working capital is negative $14 billion, and they have $14 billion of dividends. So they may need to take on more debt or equity to run their business over the next 12 months. The best way to look at ratios to compare them to similar companies, I've done videos on Bell Canada, Rogers, Shaw, TELUS, T-Mobile, Vonage, Verizon, and Zoom, all in the same industry as AT&T. And if AT&T has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're a little worse in price to earnings, a lot better in price to sales and price to book. Most companies in this industry have below 1 current ratio like them. ROE, they're much lower than the average. They are a little lower than average in debt. And they're a really big company, 204 billion market cap, much bigger than the average. And they pay the highest dividend of all the companies in this industry. So to summarize, I do have them trading at a 75% discount, but I don't think the stock is going to go up that much because I don't think many investors are that bullish on the future of this company. But they are generating a good amount of cash flow, they pay a nice dividend, and they also have pretty good ratios. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.